So Warren Buffett just made a move that could completely unravel Donald Trump's financial empire. And honestly, most people have no clue what just happened. The Oracle of Omaha, the guy who's been Trump's quiet Wall Street nemesis for years, just pulled off what financial experts are calling the most strategic divestment in modern banking history. Buffett's Berkshire Hathaway didn't just reduce their banking positions, they systematically exited every single financial institution that's been propping up Trump's debt structure. It's honestly hard to believe this happened so quietly. We're not talking about some minor portfolio adjustment here. We're talking about $37 billion in strategic exits from the exact banks holding Trump's commercial real estate loans, his development project financing, and his overseas investment vehicles. And here's the kicker. This isn't just about one billionaire making smart money moves. This is about the smartest investor in American history sending a clear signal to every other institution on Wall Street that Trump's financial house of cards is about to collapse. Let me fill you in on what's been happening behind the scenes because the implications of this are absolutely staggering. So, Warren Buffett has been in the investing game for over 6 decades. He became CEO of Berkshire Hathaway back in 1965 and built it into one of the most powerful investment vehicles in human history. His track record isn't just good, it's legendary. The man has outperformed the market for 58 consecutive years. When Warren Buffett moves billions of dollars, every single financial institution on the planet pays attention. For years, Berkshire Hathaway has been one of the largest shareholders in America's major banks: Bank of America, Wells Fargo, J.P. Morgan Chase, Citigroup. Buffett's positions in these institutions weren't just significant. They were massive, totaling over $130 billion at their peak. These weren't speculative bets. These were Buffett's core holdings, the bedrock of Berkshire's portfolio, positions he held for decades because he believed in the fundamental strength of American banking. But here's where the rubber meets the road. Starting in late January 2025, Buffett began systematically liquidating these positions, not reducing them, not trimming them, liquidating them entirely. According to SEC filings from February 3rd, Berkshire Hathaway has now completely exited its positions in Bank of America, reduced Wells Fargo holdings by 94%, and slashed J.P. Morgan and Citigroup positions to bare minimum levels. We're talking about $37 billion in banking stocks sold in just 6 weeks. Now, before we go any further, let's be real for a second. Warren Buffett doesn't do anything without a very specific reason. This is a man who famously said his favorite holding period is forever. He doesn't panic sell. He doesn't chase trends. He doesn't make emotional decisions. When Warren Buffett exits $37 billion worth of banking positions in 6 weeks, there's a calculated strategic reason behind it. Now, back to the matter at hand. Reports from around February 6th revealed just how strategic Buffett's exits actually were. These weren't random banking stocks. Every single institution Buffett dumped holds significant exposure to Donald Trump's commercial real estate empire. Bank of America holds approximately $340 million in Trump Organization loans for properties in Chicago, Las Vegas, and Miami. Wells Fargo has $180 million in development financing tied to Trump projects in New York and Scotland. J.P. Morgan services $215 million in overseas investment vehicles connected to Trump's international properties. Citigroup carries $127 million in refinanced debt from Trump's casino holdings and golf course acquisitions. Talk about a pattern. Buffett didn't just exit banking broadly. He specifically targeted every institution with material Trump exposure, while simultaneously increasing his positions in regional banks and credit unions with zero Trump connections. And this wasn't a private decision. Buffett made sure these moves were publicly disclosed in SEC filings, sending an unmistakable message to every other institutional investor on Wall Street. This announcement sent shockwaves through the financial community because it raised all sorts of questions. If Warren Buffett, the most successful investor in American history, is fleeing institutions with Trump exposure, what does that tell other fund managers about Trump's ability to service his debt? What does it signal about the commercial real estate sector Trump dominates? And most critically, what does Warren Buffett know that the rest of the market doesn't? Now, this isn't the first time we've seen this pattern from Buffett. Warren Buffett's investment philosophy has always been about one thing above everything else: protecting capital. Whenever he sees systemic risk, legal liability, or reputational damage that could threaten his shareholders, he exits immediately and completely. We've spotted this pattern time and time again. Just think about how he dumped his entire airline portfolio in April 2020, the moment he understood the pandemic's implications. Buffett held airline stocks for years, praising the industry's transformation. Then COVID hit, and within 3 weeks, he sold every single share. Southwest, Delta, United, American Airlines. Gone. He took a $5 billion loss rather than risk further exposure. Investors who ignored that signal lost another 60% over the following months. Then there was Wells Fargo. Buffett started buying Wells Fargo stock back in 1989 and held it for nearly 3 decades. It was one of his favorite positions. But when the fake account scandal broke in 2016, revealing systemic fraud and regulatory violations, Buffett didn't make excuses or wait for reform. He systematically exited over the next 4 years, reducing his position by 99%. The message was clear. Once institutional integrity is compromised, Buffett doesn't stick around hoping for redemption. And let's not forget how he avoided the entire cryptocurrency sector when Bitcoin mania peaked in 2021. While hedge funds and banks piled into crypto exposure, Buffett called it worthless and refused every opportunity to participate. When crypto crashed in 2022, wiping out $2 trillion in market value, Berkshire shareholders were completely protected. Even major financial institutions like Silicon Valley Bank fell into this pattern. Buffett evaluated SVB multiple times for potential investment, but consistently refused because he identified their risk management as fundamentally flawed. When SVB collapsed in March 2023, triggering a regional banking crisis, once again Buffett's caution was vindicated. Now, it looks like Trump's financial empire is in the hot seat, and Buffett is applying the exact same playbook. He's identified systemic risk, legal liability, and reputational damage, and he's exiting completely before the full consequences hit. So, what did Trump do to trigger Buffett's massive exit? Well, it all boils down to an escalating series of legal judgments that are systematically dismantling Trump's ability to maintain his debt structure. The situation reached critical mass because Trump is facing simultaneous financial pressures on multiple fronts. The $454 million New York civil fraud judgment requires immediate payment or bonding. The $83 million E. Jean Carroll defamation judgment is actively being enforced. Additional legal judgments totaling over $200 million are working through appeals. Criminal defense costs are running approximately $5 million monthly, and meanwhile, Trump's revenue streams from properties are declining as occupancy rates drop and sponsors distance themselves from the Trump brand. The cash crunch that's developed isn't theoretical anymore. It's immediate and severe. As the Wall Street Journal reported on February 8th, Trump has been desperately trying to refinance existing debt, secure new credit lines, and find investors willing to inject fresh capital into his organization. But here's the kicker. Every single attempt has failed. Banks that previously rolled over Trump's loans are now demanding full repayment. Lenders who offered Trump favorable terms for decades are suddenly requiring double the collateral. Investors who might have considered Trump properties are walking away after conducting due diligence on his legal exposure. And this is where Buffett's exits become absolutely devastating. When the most respected investor in American history publicly dumps every bank with Trump exposure, it sends an unmistakable signal to every other financial institution. According to Politico's report from February 9th, at least 7 major commercial lenders have now formally declined Trump Organization refinancing requests, directly citing increased risk assessment following Buffett's exits. Deutsche Bank, Trump's lender of last resort for years, has reportedly refused to extend any additional credit. Ladder Capital, which holds $280 million in Trump property mortgages, is demanding accelerated repayment schedules. Even private equity firms that typically thrive on distressed opportunities are staying away, with one managing partner telling Bloomberg, "If Buffett won't touch these banks because of Trump exposure, why would we?" At first, Trump seemed to think he could weather this storm. He appreciates loyalty from his business partners and the notion of institutions standing by him through controversy. Trump's initial strategy was to publicly attack the judgments as political persecution, while privately assuring lenders that appeals would overturn everything and his empire would emerge stronger than ever. His team put out statements claiming Trump had $400 million in liquid assets and could easily satisfy any judgment. They suggested multiple properties could be sold quickly at premium prices if necessary. They insisted that Trump's brand value remained strong and financing would materialize when needed. But as the financial pressure extended into its second month, some serious problems started cropping up. The liquid assets, Trump claimed, turned out to be grossly overstated. Properties that Trump valued at premium prices received appraisals 40 to 60% lower when actual buyers conducted due diligence. The brand value that supposedly commanded premium pricing was actually depressing property values as corporations refused to lease space in Trump-branded buildings. While Trump's team projected confidence publicly, the private reality was increasingly desperate. Multiple sources told MSNBC that internal Trump organization meetings have shifted from discussing growth strategies to analyzing which properties could be liquidated fastest to generate cash. This was the moment Warren Buffett's strategy became devastatingly clear. You see, Buffett didn't just exit Trump-exposed banks because of current risk. He exited because he understood exactly where this situation leads. Trump cannot simultaneously fight $750 million in judgments, fund ongoing legal defenses costing $60 million annually, service $1. $3 billion in existing commercial debt, and maintain operations across his property portfolio. The math simply doesn't work. Buffett knows that within the next 12-18 months, Trump will face a catastrophic choice: either liquidate major assets and fire sales to satisfy judgments and debt, or default on obligations and trigger a cascade of foreclosures and bankruptcies. And then Trump's legal team made a move that, according to Buffett's analysis, was a critical tactical error. Trump's lawyers announced they would appeal every judgment and refuse to post appeal bonds, essentially daring courts to begin asset seizure. Trump started looking for ways to delay enforcement and figured he could drag out appeals for years while continuing to operate his properties and generate revenue. He even considered restructuring the Trump organization to shield assets from creditors, moving properties into new corporate entities controlled by family members. But when financial analysts caught wind of all this, the response was swift and brutal. In Buffett's assessment, Trump's refusal to post appeal bonds or negotiate settlements signaled that he lacks the liquid resources to satisfy judgments. Attempting to restructure assets during active litigation is exactly the behavior that triggers emergency creditor action. Dragging out appeals while continuing to extract revenue from properties is precisely what motivates courts to impose receiverships and freeze accounts. Legal experts started noting that the playbook Trump was using had failed catastrophically in every previous case where it had been attempted. Jeffrey Berman, former U.S. Attorney for the Southern District of New York and definitely not a progressive activist, went on MSNBC on February 10th and made a statement that really should catch everyone's attention. He said that Trump's legal strategy of delay and defiance would virtually guarantee court-ordered asset seizures within 90 days because judges have seen this exact pattern before and have zero tolerance for defendants who demonstrate intent to hide assets rather than satisfy judgments. Just think about that for a moment. A Republican-appointed former federal prosecutor is predicting court-ordered seizures within 3 months. And this is coming from someone who spent his career prosecuting financial crimes. When prosecutors start using language like zero tolerance and intent to hide assets, that's the moment to really pay attention. Barbara McQuade, former U.S. attorney and University of Michigan law professor, mentioned that Trump's situation represents the most documented case of judgment avoidance behavior in modern legal history, and that courts have extensive precedent for imposing emergency remedies, including receiverships, account freezes, and supervised asset sales when defendants demonstrate this pattern. Now, this left Trump in an absolutely impossible position. On one side, he desperately needs to maintain control of his properties to preserve any chance of generating revenue and sustaining his political operation. His entire public persona depends on projecting wealth and success. The MAGA base supports him partly because they see him as a successful businessman who can't be bought. Losing properties to court seizures or forced sales would devastate that image and potentially crater his political fundraising, which has become his primary revenue source. On the flip side, he actually has to satisfy legal judgments that courts are actively enforcing. That means either liquidating assets, posting massive appeal bonds, or negotiating settlements. But every single one of those options requires admitting he doesn't have the liquid resources he's claimed, revealing that property valuations were inflated, and acknowledging that his financial empire was built on debt leveraging rather than actual wealth. The tricky part is all of that requires some level of transparency about his actual financial condition and cooperation with the legal process. So Trump is caught in a bind. He can either keep fighting every judgment and refusing every settlement, which means courts will inevitably seize properties, freeze accounts, and impose receiverships, and that creates exactly the asset collapse Buffett predicted, making it impossible to service existing debt and potentially triggering defaults across his entire portfolio. Or he can attempt to negotiate settlements and satisfy judgments, which means admitting financial weakness, liquidating properties at distressed prices, and revealing to his political base that the image of wealth was largely illusion, but that still might allow him to retain some assets and avoid total collapse. It's an impossible situation, and that's exactly the trap that Warren Buffett understood Trump was walking into. Buffett recognized that Trump's personality would never allow him to choose the second option, the strategic retreat that might salvage something. Trump's ego demands that he fight publicly and never admit weakness, but that psychological requirement guarantees the financial catastrophe Buffett is positioning to avoid. This whole scenario is causing major stress within the commercial real estate and banking sectors. If Warren Buffett has determined that Trump-exposed banks represent unacceptable risk and is willing to exit $37 billion in positions to avoid that exposure, every other institutional investor is left wondering whether they should be doing the exact same thing. Those moderate fund managers who are trying to balance fiduciary responsibility with relationship maintenance are now worried sick about being the last ones holding Trump-contaminated assets when the collapse finally hits. They're watching their competitors follow Buffett's lead, and they're calculating whether staying invested is worth the career risk if everything Buffett predicts comes true. Meanwhile, the aggressive investors who thought Trump's properties represented distressed opportunities are realizing that the legal complications create liability exposure that no discount can justify. If properties end up in receivership or foreclosure, buyers inherit all the legal baggage without any of the Trump brand value that supposedly justified premium pricing. Things became even more intense when Blackstone, one of the world's largest real estate investment firms, quietly withdrew from preliminary discussions about acquiring Trump properties in Florida. Blackstone had been exploring whether Trump's Miami and Palm Beach holdings might represent value plays if they could be acquired below market. Their real estate team conducted extensive due diligence through January and early February. But according to Bloomberg's report from February 11th, Blackstone executives concluded that legal entanglements and reputational risk created unacceptable complications regardless of pricing, and formally ended all discussions. When someone as sophisticated as Blackstone, with their appetite for complex, distressed opportunities, walks away entirely, you know you're in a world of hurt. This isn't about politics or personal feelings toward Trump. Blackstone's decision was purely financial. The risk-adjusted returns don't justify the exposure. Then the legal system started applying real pressure. On February 7th, New York Attorney General Letitia James filed emergency motions in state court, requesting immediate asset monitoring and preliminary injunctions to prevent Trump from transferring properties or restructuring corporate entities. She pointed out that Trump's recent corporate restructuring attempts and public statements about refusing to post appeal bonds demonstrated clear intent to frustrate judgment collection. The Attorney General's filing quoted extensively from Trump's own social media posts where he declared he would never surrender to corrupt judges and would fight enforcement by any means necessary. The legal team argued these statements, combined with evidence of asset transfers to family-controlled entities, met the legal standard for emergency intervention to preserve the court's ability to enforce its judgment. The legal process moved pretty quickly, and the judge recognized the urgency. After all, every day Trump continued restructuring assets without court supervision meant potentially millions of dollars in property value being moved beyond the reach of judgment enforcement. And let me tell you, the judge didn't hold back with the ruling. It was a major blow for Trump. On February 10th, New York Supreme Court Justice Arthur Engoron declared that Trump's actions represented a transparent attempt to frustrate legitimate judgment collection and imposed immediate asset monitoring requirements. That's legal speak for saying, you've got no solid ground to stand on here. There's no legal validity to what you're doing. You're just trying to hide assets from creditors. The ruling imposed several emergency measures. Trump Organization must now provide weekly financial reports detailing all property transactions, asset transfers, and corporate restructuring. An independent monitor will have full access to Trump Organization financial records and must approve any transaction exceeding $5 million. All corporate restructuring or asset transfers require advance court approval. Personal accounts and entities controlled by Trump family members are subject to disclosure requirements. The court reserved authority to impose a formal receivership if compliance is inadequate. Justice Engoron's written opinion was particularly damning, stating that the defendant's public statements, combined with documented attempts to restructure corporate entities during active judgment enforcement, demonstrate a pattern of behavior designed to place assets beyond the reach of legitimate creditors. Such conduct cannot be tolerated in any functioning legal system and requires immediate judicial intervention. When a judge uses that kind of language, you're not just losing a legal battle. You're being publicly identified as someone actively defying the legal system's legitimate authority. That kind of judicial finding doesn't just affect the immediate case. It creates precedent that other judges will cite, colors how every future motion gets evaluated, and signals to other creditors that courts will support aggressive collection efforts. The significance of this ruling cannot be overstated. Attorney General James now has a court-authorized mechanism to track every dollar flowing through Trump's empire. Any attempt to sell properties at below-market rates to friendly buyers gets blocked. Any effort to move assets into family trusts or overseas entities gets stopped. The independent monitor essentially functions as a court-appointed overseer with veto power over Trump's financial decisions. Legal experts are noting that we haven't seen this level of judicial intervention in a major commercial case since the Enron collapse in 2001. Jennifer Rogers, former federal prosecutor and current Columbia Law School lecturer, told CNN on February 11th that Justice Engoron's ruling represented the most comprehensive asset monitoring order imposed on a major business figure in modern legal history, and that the independent monitor provisions effectively stripped Trump of autonomous control over his own organization's financial operations. And this is exactly what Warren Buffett anticipated. Buffett didn't exit Trump-exposed banks because of current asset values. He exited because he understood that once courts impose this level of monitoring and control, the outcome becomes inevitable. Trump cannot operate his business effectively under court supervision. Properties that require aggressive management and quick decision-making cannot function when every significant transaction needs court approval. Lenders who might have refinanced debt become unwilling to extend credit to an entity operating under judicial oversight. The monitoring itself accelerates the decline by making normal business operations impossible. Conservative legal analyst Andrew McCarthy, writing for National Review on February 10th, acknowledged that while he disagreed with the underlying fraud judgment, Trump's response to enforcement had been strategically catastrophic and virtually guaranteed maximum asset seizure in minimum time. When even conservative legal voices are using phrases like strategically catastrophic and predicting rapid asset seizure, the writing is on the wall. So let's break down what this banking exodus and legal crackdown could mean, because it's not just a captivating financial story. It has serious consequences for how American commercial real estate, political financing, and legal accountability actually work in practice. First up is the immediate political fallout. Trump is already facing significant challenges due to his criminal prosecutions and deteriorating poll numbers, and his fundraising has become increasingly dependent on the perception that he remains a successful billionaire who can't be intimidated. That image is central to his appeal. His supporters don't just back him politically, they believe he represents proof that outsiders can succeed against establishment opposition. But as properties start getting seized and the independent monitor's reports reveal the actual financial condition of his empire, that narrative completely collapses. According to a YouGov poll from February 9th, Trump's favorability among voters who cited business success as their primary reason for supporting him has already dropped 11 points since Buffett's banking exits became public. These aren't partisan Democrats turning against Trump. These are voters who specifically supported him because they believed he was a competent businessman. When that competence gets publicly disproven through court-ordered asset monitoring and forced property sales, the political damage compounds. And honestly, that's not the best look for him when he's trying to maintain the image of strength and dominance that his political movement requires. Most folks in America have a good deal of respect for Warren Buffett as someone who built legitimate wealth through patient investing and careful analysis, even if they don't always agree with his politics. When Buffett sends a signal this clear, this public, and this dramatic, it shapes perception across the political spectrum. Democrats are definitely planning to take advantage of this situation. They'll argue that Trump's entire business career was built on debt, deception, and avoiding accountability, and that the image of success was always an illusion maintained through media manipulation and legal delay tactics. They'll have court findings, independent monitor reports, and Warren Buffett's $37 billion exit backing up those claims. This is going to be Exhibit A in proving that Trump never had the business acumen or actual wealth he claimed. You can expect to see graphics showing seized properties, charts comparing Trump's claimed valuations versus actual sale prices, and Buffett's exit decision popping up in Democratic campaign ads, congressional speeches, and presidential debates. Now let's touch on what this means for the commercial real estate sector itself. Major institutional investors have been working hard to maintain stability in commercial real estate markets, which have already been stressed by rising interest rates, increased remote work reducing office demand, and general economic uncertainty. Nobody wants a major asset collapse that triggers broader market panic. Each time someone with resources attempts to defy court enforcement through corporate restructuring and asset transfers, it tests whether our legal mechanisms still function effectively. The fact that courts are responding with comprehensive monitoring and receivership authority shows the system still has teeth. But the need for such aggressive intervention reveals how vulnerable enforcement has become to sophisticated avoidance tactics. These actions don't just disappear when Trump eventually loses these properties. They become part of our new legal landscape. Future defendants will study exactly how far Trump got before courts finally impose decisive intervention. Future judges will cite Engoron's rulings when dealing with similar patterns of judgment avoidance. And that's pretty significant because democracy relies on equal application of legal accountability, assuming that people in power will ultimately comply with court orders, even when it's financially devastating.